Have you noticed something that makes absolutely no sense in today's financial markets? Inflation remains a concern. Global tensions continue growing. Central banks keep buying record amounts of gold. Governments around the world are carrying enormous debt. Many investors expected gold to keep climbing under these conditions, yet instead of soaring, gold has recently pulled back. So what is really happening? Is the market sending a warning, or is this creating one of the biggest buying opportunities in years? Today, we are uncovering the real reasons why gold is falling when it should not be, and why what happens next could surprise almost everyone. At first glance, the recent weakness in gold prices seems confusing. For decades, investors have been taught that gold performs well during times of uncertainty. Rising inflation usually supports gold. Geopolitical conflict often pushes investors towards safe haven assets. Concerns about government debt frequently increase interest in precious metals. Looking at the current economic environment, many people expected gold to continue breaking record after record. Instead, the market has delivered something very different. Gold has struggled to maintain upward momentum despite many supportive factors remaining firmly in place. This has left many investors asking the same question. If all the traditional reasons for owning gold still exist, then why is the price falling? The answer begins with understanding how financial markets actually work. Markets do not simply react to current events. They react to expectations. Investors constantly try to predict what will happen months before it actually occurs. This means prices often move long before the news changes. By the time the public fully understands a trend, professional investors may have already adjusted their positions. One of the biggest influences on gold continues to be the Federal Reserve. Interest rate expectations have become the center of attention across global financial markets. When investors believe the Federal Reserve will keep interest rates higher for longer, gold often comes under pressure. Higher interest rates increase returns on assets like Treasury bonds and savings products. Since gold does not pay interest, some investors temporarily move money toward investments that generate income. This does not mean gold has lost its value. It simply means capital begins flowing toward assets that appear more attractive under current monetary conditions. Even if inflation remains elevated, investors often focus more on future interest rate decisions than on today's inflation numbers. Expectations continue driving the market every single day. The strength of the US dollar also plays a major role. Gold is priced in dollars across international markets. When the dollar becomes stronger, gold usually becomes more expensive for buyers using other currencies. That stronger dollar often reduces international demand and places temporary pressure on gold prices. Recently, the dollar has remained relatively resilient because investors continue viewing the United States as one of the strongest major economies. Strong employment reports, stable consumer spending, and resilient economic growth have supported confidence in the dollar. As long as that confidence remains elevated, gold may experience periods of weakness even when long-term fundamentals remain positive. Another important factor involves profit-taking. Many investors forget that markets never move in a straight line. Gold reached impressive highs over recent months. Whenever an asset experiences a strong rally, many professional traders begin locking in profits. Selling after significant gains is a normal part of healthy market behavior. It does not necessarily indicate that the long-term trend has changed. History shows this pattern repeating again and again. Every major gold bull market has included temporary corrections. During previous rallies, gold sometimes declined sharply before continuing much higher. Investors who understood the larger trend often viewed these pullbacks differently from those focused only on short-term price movements. There is another reason behind the recent weakness that receives far less attention. Investor sentiment has shifted toward risk assets. Whenever stock markets perform well, some investors reduce exposure to defensive assets like gold. Strong corporate earnings optimism surrounding artificial intelligence and confidence in technology companies have attracted enormous amounts of investment capital. Money constantly moves between different asset classes. When confidence in stocks increases, gold sometimes experiences temporary outflows. This rotation has occurred many times throughout financial history. It does not mean investors suddenly believe gold has no future. It simply reflects changing priorities within global investment portfolios. Inflation expectations also deserve careful attention. While inflation remains above many central bank targets, recent economic data has suggested that price pressures may continue easing over time. If investors become convinced inflation is moving under control, demand for inflation, hedges like gold can temporarily weaken. However, this creates an interesting contradiction. Even if headline inflation declines, many everyday expenses remain significantly higher than they were only a few years ago. Housing, food, healthcare, insurance, and other essential costs continue affecting household budgets. This means inflation has not disappeared. It has simply slowed from extremely high levels. That difference is important because markets often react to the direction of inflation rather than its absolute level. Central bank buying tells a completely different story. While some short-term investors have reduced exposure, many central banks continue accumulating gold reserves at one of the strongest rates seen in decades. Countries around the world are increasing diversification away from traditional reserve assets. Gold remains one of the most trusted stores of value available to governments seeking long-term financial stability. This difference between institutional buying and short-term market selling creates one of the most fascinating developments in today's precious metals market. On one side, traders react to daily headlines, interest rate expectations, and currency movements. On the other side, central banks continue steadily purchasing physical gold regardless of temporary price fluctuations. Geopolitical uncertainty has also remained elevated. Conflicts in several regions continue affecting global trade, energy markets, and investor confidence. Traditionally, these conditions support gold because investors seek assets that can preserve wealth during uncertain times. Yet the market has not responded as strongly as many expected. Why is that happening? Because markets sometimes become accustomed to ongoing uncertainty. A sudden, unexpected event often produces a stronger reaction than risks that investors have already been watching for months. Financial markets constantly adjust expectations. Once a major risk becomes widely recognized, its immediate impact on prices often begins fading unless conditions suddenly worsen. Another overlooked factor is the remarkable resilience of the American economy. Many analysts expected higher interest rates to push the economy into recession much sooner. Instead, employment has remained relatively strong. Consumer spending has continued supporting growth. Businesses have adapted better than many experts predicted. As long as economic data continues surprising to the upside, investors may feel less urgency to increase safe haven exposure. Yet this is exactly where history becomes extremely interesting. Looking back across previous decades, we find that gold often experienced periods of weakness before some of its largest advances. Temporary corrections frequently occurred while investors questioned whether the bull market had already ended. Those moments of uncertainty often became the foundation for the next powerful rally. The psychology behind these moves is fascinating. When prices fall, many investors begin doubting their original investment thesis. Fear replaces confidence. News headlines become increasingly negative. Analysts debate whether better opportunities exist elsewhere. This emotional shift often causes weaker investors to sell, while patient, long-term investors quietly begin accumulating positions. Professional investors understand that markets frequently test conviction before rewarding patience. They recognize that temporary weakness does not automatically signal permanent decline. Instead, they study broader economic trends, monetary policy, inflation, expectations, central bank behavior, and global financial conditions before reaching conclusions. That broader perspective reveals something many casual investors may be missing. Several long-term drivers that have supported gold for decades remain firmly in place. Government debt continues expanding. Central bank demand remains historically strong. Geopolitical uncertainty has not disappeared. Inflation risks still exist. Questions surrounding future Federal Reserve policy remain unresolved. These factors have not vanished simply because gold experienced a pullback. The real question is whether the current decline represents the end of the story or merely another chapter in a much larger cycle. History suggests that answer may be far more surprising than most people expect, and once we examine what has happened during previous periods just like this, the current weakness in gold begins looking very different indeed. To understand why the current decline may not tell the full story, we need to step away from daily headlines and look at the larger historical picture. Gold has never moved in a perfectly straight line. Every major bull market has included periods that looked disappointing at the time. Investors questioned whether the rally was over. Financial media focused on negative price action. Analysts reduced their forecasts. Yet those same corrections often became the launching point for much larger gains. One of the clearest examples came during the last major precious metals cycle. Gold experienced several sharp pullbacks even while the long-term trend remained firmly intact. Each correction convinced many investors that the opportunity had passed. Some sold their positions believing the market had reached its peak. Others waited for even lower prices that never arrived. As confidence disappeared, the foundation for the next advance quietly formed beneath the surface. Markets have always been driven by emotion as much as economics. Fear and greed constantly compete for control of investor decisions. When prices rise, investors become confident. When prices fall, that confidence quickly disappears. The facts may remain largely unchanged, but emotions begin influencing decisions more than fundamentals. This emotional cycle explains why short-term market movements can sometimes appear disconnected from economic reality. Investors react not only to what is happening today, but also to what they believe could happen tomorrow. If expectations become too optimistic, markets often correct. If expectations become too pessimistic, opportunities frequently begin appearing. The bond market has also become an important piece of the current puzzle. Rising Treasury yields have attracted investors searching for relatively safe returns. Higher yields increase competition for gold because bonds now offer stronger income than they did during years of extremely low interest rates. Some investors who previously held gold for stability have temporarily shifted part of their portfolios toward government bonds. However, this relationship is rarely permanent. Bond yields constantly change as economic conditions evolve. If inflation remains stubborn, or if economic growth begins slowing more rapidly than expected, expectations for future interest rate cuts could return quickly. That shift would likely reduce pressure on gold, while increasing its appeal once again. Another important consideration involves real interest rates. Gold often performs best when inflation rises faster than interest rates. Even if nominal interest rates remain elevated, persistent inflation can reduce the purchasing power of those returns. Investors closely monitor this relationship because it directly affects the attractiveness of holding physical gold. Supply also deserves attention, even though it rarely dominates financial headlines. Gold production does not increase overnight, simply because prices move higher. Discovering new deposits, developing mines, securing permits, and building production facilities can take many years. This slow supply growth means long-term demand often has a greater influence on prices than many investors realize. Demand itself remains surprisingly resilient despite recent weakness in market prices. Jewelry consumption continues supporting the market across many regions. Investment demand fluctuates depending on market conditions, but physical buying often increases during periods of lower prices. Many long-term investors see corrections as opportunities rather than reasons to panic. Central banks continue reinforcing this idea through their purchasing activity. Around the world, governments have been increasing gold reserves as part of broader diversification strategies. This trend reflects growing interest in reducing dependence on traditional reserve currencies. While daily trading creates volatility, steady institutional accumulation provides important long-term support for the market. Silver adds another interesting dimension to the discussion. Although this video focuses primarily on gold, silver often provides clues about broader precious metals sentiment. Unlike gold, silver benefits from both investment demand and industrial demand. Solar energy, electric vehicles, advanced electronics, and artificial intelligence infrastructure continue requiring significant amounts of silver. If industrial activity remains healthy, while investor demand eventually strengthens, silver could experience substantial momentum. Historically, silver has often followed gold during major bull markets, but with even larger percentage moves. That relationship continues attracting attention from experienced precious metals investors. The global economy also remains filled with unanswered questions. Economic growth has proven stronger than expected in some regions while slowing noticeably in others. Manufacturing activity continues fluctuating. Consumer confidence changes from month to month. Businesses remain cautious about future investment decisions. These mixed signals create uncertainty that can shift market sentiment very quickly. Currency markets remain equally important. The US dollar continues influencing global commodity prices because most international trade in precious metals takes place in dollars. A stronger dollar usually creates short-term pressure on gold, while a weaker dollar often provides support. Investors therefore monitor Federal Reserve policy not only because of interest rates, but also because of its influence on currency markets. Government debt continues reaching historically high levels across many major economies. Financing that debt becomes increasingly challenging when borrowing costs remain elevated. Policymakers must balance controlling inflation, supporting economic growth, and maintaining financial stability. These competing priorities create uncertainty that has historically supported long-term interest in precious metals. Another factor worth considering is the changing behavior of retail investors. During recent years, millions of new investors entered financial markets through online trading platforms. Many focused heavily on technology stocks, cryptocurrencies, and other high-growth assets. As long as those sectors continue attracting attention, gold may receive less enthusiasm from smaller investors. Yet market leadership rarely remains the same forever. Throughout financial history, different asset classes have taken turns outperforming. Periods of excitement surrounding one sector often create opportunities in another. Gold has repeatedly demonstrated its ability to regain investor attention when broader market conditions begin changing. Professional investors often prepare for those shifts long before they become obvious. Instead of reacting emotionally to every daily headline, they evaluate long-term macroeconomic trends. They analyze inflation expectations, monetary policy, government spending, global liquidity, and central bank activity. This broader perspective helps them identify opportunities that short-term traders may overlook. Market positioning also matters. When too many investors become bearish, selling pressure eventually begins running out. Once most sellers have already exited the market, even modest buying demand can produce meaningful price recoveries. This is one reason experienced analysts pay close attention to investor sentiment alongside economic fundamentals. Looking back across the last 50 years reveals another consistent pattern. Gold has often surprised investors precisely when confidence reached its lowest point. Moments that appeared most discouraging sometimes marked the beginning of powerful recoveries. Those recoveries rarely started with dramatic headlines. They developed gradually before accelerating into much larger trends. Today, many of those same psychological conditions appear once again. Questions dominate financial discussions. Investors debate whether higher interest rates will continue. They wonder whether inflation has truly been defeated. They question the strength of economic growth. They speculate about future Federal Reserve decisions. This uncertainty creates hesitation throughout financial markets. Yet beneath that uncertainty, several supportive forces remain active. Central banks continue buying. Global debt continues expanding. Geopolitical risks remain elevated. Physical demand remains resilient. Supply growth remains limited. These factors have not disappeared simply because prices experienced a temporary decline. The biggest mistake investors often make is assuming that recent price action alone tells the complete story. Markets are influenced by countless variables working together at the same time. Short-term weakness does not automatically erase long-term fundamentals. In many cases, it simply reflects changing expectations that eventually adjust again as new information becomes available. And there is one final reason why gold may be falling today, even though many believe it should be rising. It is a reason rooted in market psychology rather than economics alone. Understanding this final piece could completely change the way investors view the current correction and what it may signal for the months ahead. The final reason is simple, but it is also the one that surprises the greatest number of investors. Gold is falling because the market has become too focused on the present while ignoring the future. Financial markets are always trying to look several months ahead. Investors constantly adjust their expectations before economic conditions actually change. This creates periods when price movements seem completely disconnected from reality. Yet once expectations shift again, the market often moves with incredible speed. Think about what happens whenever the Federal Reserve signals that interest rates may remain elevated. Investors immediately begin pricing in that possibility. Gold weakens because traders expect tighter financial conditions. But if economic data suddenly begins slowing or inflation proves more persistent than expected, those same expectations can reverse within weeks. Gold does not wait for official announcements. It reacts as soon as investors believe the next policy move may change. History shows that some of the strongest gold rallies have started before the first interest rate cut ever occurred. Investors who waited for complete confirmation often missed the early stages of the move. The market rewarded those who understood how expectations influence price action rather than those who focused only on current headlines. Another reason patience matters is because financial cycles rarely end the way most people expect. During periods of optimism, investors often assume economic growth will continue forever. During periods of fear, they believe problems will never end. Reality usually falls somewhere between those extremes. Gold benefits when expectations become too one-sided because markets eventually return to balance. There is also the issue of global uncertainty that continues building beneath the surface. Political tensions remain elevated. Trade relationships continue evolving. Supply chains still face challenges in several industries. Government borrowing remains historically high. None of these issues disappear simply because gold experiences a temporary correction. In fact, many of them continue strengthening the long-term investment case for precious metals. Central bank demand may become one of the most important stories over the coming years. Many countries continue increasing their gold reserves while reducing reliance on traditional reserve assets. This is not short-term speculation. It represents strategic long-term planning. When institutions with enormous financial resources continue buying physical gold, despite market volatility, investors should pay close attention. Silver may also become an important part of the next chapter. If gold eventually regains momentum, silver has historically followed with even greater percentage gains. Industrial demand continues expanding through renewable energy, advanced electronics, artificial intelligence infrastructure, and electric vehicles. Combined with investment demand, this creates a unique combination that few other commodities possess. The relationship between gold and the US dollar will remain another major driver. If the dollar begins weakening because of changing interest rate expectations or slower economic growth, gold could receive significant support. Currency markets influence global investment flows every single day. Even small changes in expectations can create meaningful moves across precious metals. Investors should also remember that corrections are healthy. Markets that rise without pauses often become unstable. Temporary pullbacks allow excessive optimism to cool while creating opportunities for long-term buyers. Every major bull market in modern history has included periods that tested investor confidence. Those who remained focused on long-term fundamentals often benefited the most. This does not mean gold will immediately return to new highs tomorrow. Markets remain unpredictable in the short term. Economic reports can surprise investors. Inflation may change direction. Federal Reserve policy may evolve differently than expected. Geopolitical developments can quickly alter market sentiment. These factors create volatility that every investor must understand. What matters most is recognizing the difference between short-term noise and long-term trends. Daily headlines often exaggerate temporary market movements. Long-term wealth is usually built by understanding larger economic cycles rather than reacting emotionally to every price swing. Looking across today's financial landscape, several important themes remain in place. Inflation has slowed but has not disappeared. Government debt continues growing. Central banks continue accumulating gold. Global uncertainty remains elevated. Interest rate expectations continue changing with each new economic report. These are not conditions that suggest the precious metals story has ended. Instead, they suggest the story is still developing. This is why many experienced investors continue watching gold so closely. They understand that periods of weakness often create opportunities rather than permanent setbacks. They recognize that market sentiment can change much faster than economic fundamentals. Once expectations begin shifting, the recovery in gold can happen far more quickly than most people anticipate. The biggest lesson from history is that gold has repeatedly challenged the majority opinion. When everyone believed it would continue falling, the market often recovered. When everyone believed it could only move higher, corrections followed. The precious metals market has always rewarded discipline, patience, and long-term thinking over emotional reactions. So why is gold falling when it should not be? The answer is not because gold has lost its value. The answer is that short-term expectations surrounding interest rates, the strength of the US dollar, profit-taking, and investor rotation into risk assets are temporarily outweighing the powerful long-term forces that continue supporting precious metals. Those short-term pressures may not last forever. History suggests they rarely do. The coming months will be extremely important. Every inflation report, every employment number, every Federal Reserve statement, and every major geopolitical event will influence market expectations. Investors who stay informed instead of reacting emotionally will be in the strongest position to understand where the next opportunity may appear. If history teaches us anything, it is that the biggest opportunities often arrive when uncertainty is highest. Gold has survived financial crises, wars, inflation, recessions, and decades of changing monetary policy. It has remained one of the world's most trusted stores of value because its role extends far beyond short-term price movements. Whether the next major rally begins next month or later, the long-term factors supporting gold continue attracting serious attention from investors around the world. That is why today's decline may ultimately be remembered not as the end of the story, but as another temporary chapter before the next significant move. Thank you for watching. If you enjoyed this analysis, please like this video and subscribe to Silver and Gold Watch for more updates on gold-silver inflation, the Federal Reserve, and the global economy. Turn on notifications so you never miss our latest market insights. I also want to hear from you. Why do you think gold is falling right now? Do you believe this is a buying opportunity, or do you expect prices to move even lower? Share your thoughts in the comments below, because your opinion helps create valuable discussions for everyone in our community. Until next time, stay informed, stay patient, and keep watching the markets, because the next big move could happen when very few people are expecting it.